Welcome to class. It's tricks you can say through which you can very easily and quickly check certain parameters of a company's, which will help you do fundamental analysis. So the very first thing which we will try to understand in this class is why exactly we are doing the ratio analysis class. What is the purpose of ratio analysis? So this class 29 is more about the theoretical and philosophical part of ratio analysis. And next two chapters, class 30 and 31, will be where we will exploring different financial ratios. We will try to learn how to calculate them, how to compare them, how to give the value for certain ratios in certain industry. Mapping of right ratios with the right industry is equally important. What I'm trying to tell you that there are many different type of ratios. I'm sure some of you or many of you would have heard about it. If not, then yes, there are many different types of ratios, category of ratios, and within each category there will be different number of ratios, right? And these ratios will help you determine different status of the companies. Well, what is very important is that certain ratios will work really well into one sector, and it will be not that important for the other sector. So that mapping is equally important. So when you know how much you should be intelligent, so you should be intelligent up to this level that when you are going to analyze, let's say, banking sector stocks, then it should immediately click that okay, if I'm looking into banking sector stock, these are the 3 4 ratios which I have to quickly look into first. You may want to cover all, but yes, initially these 3 4 ratios are important for banking sectors. However, some other set of 3 4 ratios will be important for the IT sector. So this is what is something which I think will be I'll be able to give you as a takeaway from this class and next 2 class on financial ratios. And this class we will cover mostly the theoretical part. So the first thing first, I want you to think about one aspect here first before we go and further understand that what is the purpose of financial ratio. That is it possible for you to find the exact value of the company as a retail investor? Well, there are two part of it. Let's one part is when we have seen in a screener the net worth of the company. So let's say we opened TCS. You see that market capitalization is 6,77,000 crore. What is market capitalization? This is the value what shareholder, financial market, stock market is giving Tata Steel, Tata Consultancy. Tomorrow, if this share price goes from 1806 to 1706, this market capitalization will come down, and this keeps on happening. So can we say that this is the exact value of Tata Consultancy Services? Well, I think this is not the exact value, but this is the market capitalization. This is the today's value. If the market is closed, this is the value after closure. If market is still running and someone is showing you the market capitalization in the live rate, it is the value of that firm at that moment. The perceived value, the value at which the transactions are happening. Another thing which you learned is through balance sheet, you will be able to find out the reserve and share capital. This, if you add together, you come to know that this is the worth of the company, net worth of the company. So net worth of the company you can see is anything like 89,450 crore, right? However, the market capitalization is how much? 6,77,000 crore. The question here is it the right value, or the net worth is the right value, or the market capitalization is the right value, or right value is something else? Well, for every person, this is the market capitalization. This is what you have to perceive if you want to go and buy Tata Consultancy Services tomorrow at the market open, for you, this is the value of this company. This is the net worth, this is the value of this Tata Consultancy firm if you are defining it, However, the net worth would be something which you have picked up from balance sheet. But as an analyst, as a person who is going to invest into certain stock, you will be always interested into one thing, that finding the exact value, finding the intrinsic value of the firm. Obviously, the firm cannot have the net worth as their intrinsic value. Why? Because I have shown you through examples that a person opened a shop with 1 lakh rupee, even he became a 500 crore guy after some time. So after 2-3 months, he was not ready to give you his firm, divide his firm with you, share his firm with you at whatever the net worth he had in terms of the money. Because there is a rate at which this company is already generating a lot of profit, and that rate is more than FD rates, and that's why people are ready to give them a premium. And when I say people, it is the market which is giving them a premium, and this premium is almost 224 is the book value, which is and the current price is 1806, which is the market capitalization price. So you can see that at least 6 to 7 times premium market is ready to give for Tata Consultancy Service. Now your point would be, do you want to give this premium, or you want to first calculate that what should be the exact value of this company, considering what? Considering many factors, and those all factors will have to be given a number. That number will be nothing but a variable. For you, the variable could be that TCS at the same rate is going to sustain for another 30 years, will be your number. However, my number could be 20 years. Another analyst number could be 25 years. TCS might have lot of assets. Okay. So my point here is, nobody can be ever sure, 100% sure, that what exactly is the current value of this organization, or what should be the optimum or the right value of this organization. Whether 1806 rupees is the right price at which you should buy, or it should be 1500 rupees, or it is 2100 rupees and it is certainly undervalued stock, and that's why you should buy. But to arrive at any number, you have to do certain calculation, and that calculation is called nothing but finding the intrinsic valuation of a company, right? Doing the intrinsic valuation of the company. Now, point here is, this course is made for people. The audience of this course is not someone who is doing merger acquisition, who is not part of a big investment bank and already doing intrinsic valuation and having a team of 10-15 people along with them, and they have to cover only 2 or 3 companies. So people have different challenges. You as an investor or a early student who want to make a career into that segment will have a different challenge, and the challenge is like you are alone, you have to do it all by yourself. So do you think you will be able to, let's say you have to make a portfolio of 10 to 12 companies, is it possible for you to find the exact value of the company as a retail investor? I don't think it is possible. It is not humanly possible for one person to do all the intrinsic valuation and then identify the near about correct value of these organizations. Because see, if you have to select 7 or 8, obviously you will be screening 100. So hundreds of companies, finding their intrinsic valuation will be a mammoth task. You won't be able to do it. Many of the people will be not able to do it, and even some of the organizations are not able to do it. When I'm saying organization, it could be a small firm, investment management firm, portfolio management firm, so it becomes difficult to find the intrinsic valuation. This is what I was trying to tell you. In between the net worth and market capitalization, there is a intrinsic value of a firm which is the dream number for everyone to find. But this is not that easy to find, right? So, why it is not easy to find? As I was telling you, that arriving at the right value for every variable will be a difficult task. As I said, in order to find the intrinsic valuation, you have to have many numbers which will come in the form of variable. It could be depreciation, it could be constant growth, it could be the number of year till the time this company is going to sustain or generate at the same rate. It could be the exchange rate consideration which you have taken. So many variables will be there, and these variables are the real challenges of the intrinsic valuation. Arriving at the right variable is quite a task for you and for everyone. And that's why you have ratio analysis. In ratio analysis, what you do is you basically do relative valuation. So instead of finding what should be the optimum price of one apple, let's say in a vegetable market, what is easy to find out is there are 7 to 8 apples kept, and you, being an experienced fruit buyer, go and check them by touching them, by looking at their texture, by smelling it, by also looking at the shape of this apple, and then saying that, okay, with my own experience, I find this is the best apple and this is what I want to buy, this is the one which I want to eat, right? So relative valuation is relatively easy than intrinsic valuation, and that's why this is quite famous. However, when I was teaching you financial statements, I told you that you do not have to remember or mug up the ratios, because none of the ratio will stand alone do all the magic for you, the magic of finding the right stock for your portfolio, right? So relative valuation will help you create your portfolio, and in the process of coming to the right portfolio, what you will actually want to do is you want to evaluate this company. So how is company using its resources to generate the best outcome? So the evaluation on terms of the efficiency, that okay, every company is having certain capital with them which is at work, and that capital job is to generate more profit and bring more capital on the table, right? So you may want to evaluate it standalone without comparing first, that is this company giving enough return more than fixed deposit rates, return better than the debts which are available in the market, or other investment avenues which are there. So you want to evaluate the company, and there are certain ratios which will tell you, at the end of the day, these numbers will be coming from the financial statements only. But the point here is, for the sake of ease, for the sake of convenience, people in this industry, people who have written books, literature on this, or when financial management evolved, they termed it all together as a chapter, ratio analysis. And they said that, okay, it will be very difficult for you to go and glance at all the financial statements and remember the terms from there, because anyway you need to combine different numbers from all the 3 financial statements to draw some conclusions. So what they said that, okay, we will create certain ratios, and every ratio will have certain meanings, and most importantly, there will be not one ratio which will be very much compatible with one company or one sector. It will be a combination of ratios. What is something we also have to remember here, that few of the ratios will be very important for one sector, and other set of ratios will be not that important for that sector. So this mapping is also something which we will learn in these classes, in this class and next 2 classes, right? So ratio analysis purposes are evaluation. It will help you evaluate. Then obviously, as I told you, it is a way of doing the relative valuation. So how is the company performing against its peer or industry benchmark is something you can also look or understand from certain ratios which are available, which will be available with you in some time, right? Then ratio analysis will also help you identify the health of the company. How is the company going to sustain in difficult time? Yes, company is making profit. This company is better than other peers. But is this company also capable enough to sustain within the difficult time? Is this company, maybe that they are better because they are very aggressive, you know and they are giving good return because again they are very aggressive. But what is also important, that you want this company to sustain, right? And for sustainability, again there will be some ratios which you can understand and learn, and it will help you find the health of the company. So these are the purposes of ratio analysis which I have defined in my own language. Now, as I told you, there are so many entries in different financial statements, correct? In profit and loss statement, you saw there are many entries. Same with cash flow and balance sheet. Now, that you are going to combine mostly one or two or three entries from these, or even more than three entries from these financial statements, what will happen that there will be many financial ratios which will come to the picture, right? Now, all those financial ratios can be also pulled together, categorized together. And this is what again you will find in different literature. People have termed it, given it different terminologies. I have identified four different categories based on again the theory which I have been teaching you, and they are profitability, liquidity, valuation, and solvency. What is the meaning of profitability? Right. So profitability is very, it looks very simple in terms of that whether company is profitable or not. Obviously the company main aim is to generate profit. Yes, company will be generating profit of 200 crore, 300 crore, 500 crore. But do we really need to check that? No. What we need to check? We need to check the percentage form, that at what is the rate of profitability, how much capital was employed to make this profitability, how much equity capital was there to generate this profitability. I've given you two example here also, return of equity and return on capital employed. We will cover these in details in the next classes, next two classes. But yes, one thing which you always have to remember is the profitability ratio. This is something which will be common among all the sectors, because in all the companies you may want to see whether profitability ratio is good for one company among its peers, among the industry benchmark also. Now, liquidity ratio. Every company is into operation where they have to have cash in hand. Cash in hand means always the cash position should be good. This is what we learned in the last class, previous class, which was cash flow statement, that you always have debt to pay, short term debt, and you always have account receivable. You have given the products, and in a month or two you will receive the payment from your people from whom you have sold. You have taken raw material from other services from other vendors in advance. You have not paid yet. You will get this money and then you will pay this back. So what you really want to also check is the company ability to pay its short term debts. And there are enough number of liquidity ratio which are present and which you will learn. They are called current ratios, quick ratio, inventory turnover ratio. So liquidity within the firm is very important. It has to be very smooth. The company operation should be smooth. Nothing should get stuck because of the cash, or because of if anything get stuck, be it cash, be it inventory, be it raw material, be it for final produce, it is not good for the company. The company has to run, as I say, what is the common thing we use? We are running a company. The company, the running or the flowing or the liquidity is one or the other part. A company will really run smooth if the liquidity is there. So different kind of liquidity ratios are there, and we will learn about liquidity ratio. Valuation. Market value of the company to its financial metrics. What I show you on a screener was market capitalization. So you know that at certain point of time, this company is demanding a valuation, right? Now, what is that valuation? Is that market capitalization of that company? But then at that market capitalization, what exactly this company is giving to its investor? You may be thinking about investing into that company still, but then there will be many other investors who are already invested. So when they are already invested, what exactly they are getting in return of that? What is the relationship of the current market capitalization or the current value of the firm, which is the market value of the firm, against what investors are getting through that company is what you will learn in valuation. And they are very famous, ratios. I'm sure this is one of the very famous ratio, PE ratio, price to book value, price to sell. So you can see that everywhere price is getting used in the valuation ratio. So price is which price? Obviously the share price, the price at which this current market capitalization has been decided for this firm. So in the fourth category of ratios, we will learn about the valuation ratio. Then businesses, companies are all about businesses. I've been telling you from very very long time, and businesses are very very unpredictable, environments are very very unpredictable, business environments are unpredictable, certain sectors are unpredictable, one economy factors could be unpredictable. So every company should be very much well prepared to sustain for 6 months, 1 year in the wrong phase. So in they may want them, they might have done all the preparedness and readiness as per whatever the factor they already know, but then there could be one factor they didn't perceive, they didn't account, or even if they were aware, they didn't account because they can't account into the system. That could be hedging against, that could be very very risky. Hedging means that this is one issue which can happen, that, but then you also know that safeguarding yourself against that issue will be so expensive that it will hit your profitability for a very very uh, for hit the profitability in a very severe manner, or it may not even give the profitability just because you want to you know probably you want to cover that kind of risk which you already know. It could be anything. So that in that situation, if you arrive, you have to make sure that you are able to sustain within that bad period. For example, this COVID-19 crisis has come. Nobody would have accounted for this, right? As you know that we always prepare the fresh lectures. This is the one of the reason why we prepare, because we have so many things happening around us, which can be taken into every lecture. So COVID-19 was one situation you would have never imagined. No, none of the businesses would have ever imagined, and it is here. Nobody was ready for this, right? But then there will be many companies who will sustain, and so many other companies who won't be able to sustain, right? So you must be knowing what are the factors which help companies sustain in the long run, and those factors can be explained through certain solvency ratios. So these are the four type of ratios. Under each type we are going to cover more and more different type of ratios in upcoming two classes. Now, what should be our goal from the ratio analysis? First, learn industry standard. It is not you who is going to do it alone. Okay, the most famous ratio also tell you what are the factors industry look at while analyzing companies, right? So let's say I'm gonna teach you 20 different ratios, and I'm also gonna tell you that out of these 20 ratios, the industry meant equity research industry, value these 6 ratios more for certain sectors, and I give you this mapping, then it also tell you that even if you are not very much well versed with the sectorial analysis, these kind of information will help you understand that what are the critical factor for any sector, and this is what will be our goal to achieve through ratio analysis. It is not going to be just one theoretical class on ratio analysis or one literature which you can find anywhere. If you Google ratio analysis, you will find pool of literature. But then what is the meaning of learning it from a teacher or a person who is already have experience into this? The purpose or the goal which I have defined for you is you have to understand and remember this piece, that certain ratios will be important for certain sector, and always you have to map this kind of information, and we will do it through examples in the coming classes, right? When we will pick up ratios, at that point of time we will also so how this lecture is progressing. So this is the theoretical part. In next part we will cover about the important ratios, and in third part, which will be class 31, which is going to be the most exciting one. By that time you will have enough understanding about the purpose, theory, philosophy, and you would be knowing the ratios also in class next class 30 class, and on last class on ratio analysis, what I'll do, that I'll give you a chart with mappings, that okay, if you are going to analyze these sectors, these are the ratios which you need to look at. And why industry tell you that, why I tell you that, obviously I'm not going to give you something new. I'm also going to tell you something which is the industry standard practices. So through ratio analysis class in this course, one thing which you will learn is the industry standard for different sectors. Equity research industry standard for different sectors. I repeated it because I don't want you to confuse between industry and sector. When I'm talking about industry standard, it is about equity research industry standard, investment banking industry standards, Then learn to calculate by self. So you do not have to remember. Again, I'm telling you. You do not have to remember. You have to go, and since you already know financial statements now, the entries in those financial statements I didn't cover in detail. I told you only the broader heads, but in ratio analysis we will go into the detail. So every broader piece from those financial statements will be dissected into all the different heads which are already defined, and then we will learn about them, how to calculate those ratios, because only when we know those terminologies we'll be able to calculate the ratio. Then obviously this mapping thing which I am talking about, learn to map the right ratios, is something which we will learn. So I'll see you in the next lengthy class, and it is going to have many videos. Maybe in some videos I'll club together 2 ratios or 3 ratios. In one video there could be just one ratio, so in a very priority wise manner, that certain ratios you need to know in the very beginning, and certain ratios will have lower priority. So I'll keep that order of priority in consideration in class 30, where we will learn about all these 4 different category of ratios. What I really don't want you to confused about, that why I have written these 4 type of ratios. However, you have went ahead and searched different literature which is talking about only 3 ratios or 5 ratios or 6 different type of ratios. Well, many of the ratios will overlap with each other. What is important is I give you a order of priority, and that's why I'm going to club all those in a single class, which is the next class, with order of priority and not within different categories. Right. So see you in the next class. Thank you for attending this class 29, and let's jump to class 30, where we will learn about different type of financial ratios.